Hey everybody, welcome to the morning market briefing. It is Wednesday, February 11th, 2026. Hope you're doing well out there. Tom, how we doing?
Doing well. We've got some hot data coming in. Some interesting data for sure.
Yeah, so we got non-farm payrolls coming through. We're looking for 65,000. Last reading was 50,000 and an unemployment rate at 4.4. Let's see where we come in.
Color me shocked here, but the numbers came in at a gain of 130,000 and the unemployment rate came in at 4.3. Now, here's the deal. I put this in the notes because there was a lot of people who are concerned that they're changing the methodology on the jobs report effective today, which is that they're going to basically drop the births, deaths adjustment. Now, you may be thinking that has to do with people. It does not. So it's basically a smoothing model piece that they put in where they basically make up jobs. And it causes, I think, what a lot of the revisions have been in the past have basically been this. So the birth, so first of all, what they do is they exclude deaths. So if you're on part of the surveying list for that particular time period and you report no jobs whatsoever, and you used to have jobs.
You say, hey, like Narwhal went out of business. Yeah, that's a death.
That's considered a death. And those are actually excluded. So you are removed from the survey data, and they don't account for your death.
Yeah, they don't say there used to be 20 employees and now there's 0. They just say it was never there.
Yeah, they just delete that data out. And then the births is essentially they make up what they call, and the wording is unobserved births. So they make up jobs and they add them. And so you've seen
I'll tell you, unobserved birth, that's kind of the birth you want to have.
Yeah, so there's a lot of, so basically what they do is they exclude dead businesses altogether, and then they pretend that some were born, and then they add that to the model, and that is part of the jobs report. And so in the interests of
counting actual jobs,
they have removed that as of today, and there was an expectation that there could be 1 million jobs wiped off the board. I mean, I was reading through it. They're like, if this number comes in insanely low, be considering the fact that we've just been pretending to have jobs, and rather than having those backwards revisions like we had during the Biden administration, where basically there were no jobs added, even though they touted all these unbelievable job gains. So there will be more volatility, in my opinion, going forward, because those jobs will be real jobs gained and lost, and they won't have that smoothing effect of unobserved births being added. But this is a real surprise to me. I'm very surprised by this big beat. I mean, I've very much been in the camp of, we're probably at a much higher level of unemployment than people think. I think this probably slows the roll on cuts, at least in the short term. So, I mean, one thing I'd meant to take a look at before the call started, got a little behind, but we've been a real follower, not so much recently, but we used to use this website quite a bit, of a company called layoffs.fyi. And even this morning, Block, formerly Square, and Jack Dorsey, formerly CEO of Twitter, X, formerly Twitter.
Yep.
They announced they were laying off 10% of their workforce at a move for efficiency, and that's something we've seen across the board. So it's pretty interesting that this number came in hot. I'm going to quickly pull the actual raw data, see if I can figure out what sectors they were in, to see if maybe there was a little bit of canoodling here. But I'm going to let you take the mic.
I would find this data perhaps even more surprising were we not inherently so skeptical of the jobs data, even with the right sizing and more correct treatment of birthed businesses that have not been observed and deceased businesses. But I don't have faith or confidence in these numbers. It certainly flies in the face of the layoff narrative that we have seen consistently. I certainly think it cools the expectations. I'd be curious if WIRP has moved at all for rate cuts, just because when you look at the inflation narrative, and this is something I'm curious, Tom, do you think that the Fed is going to have a bit of a challenge? I was talking with somebody last week. Do you think the Fed's going to have a bit of a challenge transitioning away from such a singular focus on inflation and shifting more to the job side, because it seems like it was really, although there's a dual mandate to keep prices stable and employment full, so to speak, we've been pretty singularly focused on the inflation side for 4 years now.
Yeah, I worry that they go too far. I think there's a natural rate of unemployment. I think it still is much higher than this reported number of 4.3, though I am clearly subject to being wrong. I think that I worry that they attack it too hard. The natural level of unemployment needs to rise because we've gotten so into the print money, employ everybody, everything's in a bubble. Zestimates are in a bubble. Employment's in a bubble. Potentially AI companies are in a bubble. There's so many different things where we pump so much money into the system that we don't know what the natural rate of anything is anymore. And we've changed the goalposts so many times where, we got to like 3% unemployment. So maybe we should be there. But the answer is probably not. That was probably too high. And I think that we need to let everything kind of settle. I think that inflation is roughly 2. I think they should probably, to be a little bit smoother in how the market operates, probably somewhere around a 3% on the federal funds rate. And from there, I don't think they need to make too many adjustments. I think they need to see where we end up. Because if you look at a lot of these numbers, the unemployment rate, you look at the number of job openings, we're basically back to where we were in 2019, late 2019, where they were starting to hike rates away from 0 because we were kind of in a position where we're easing too much. And at that time, these numbers were functionally the same. So why do we need to be significantly lower if these numbers were the same 6 years ago and we were hiking? They're hiking to get to maybe 3%. Where we need to be. And so, I'd be interested to see how this turns out. But this is a real surprise to me. I thought the outcome was probably going to be, given the adjustments and the birth deaths model thing, that we might actually be in a surprise where they were like, we wiped off 1 million jobs. But
even without that, I mean, honestly, without that, I would have expected the unemployment rate to take up. Even without an adjustment to the model.
I mean, you just hear, the government part of this is the big downside. So I was just looking through the, plus minuses here on the most recent report. Construction down, federal government payrolls was a 2, financial activities up 7, government payrolls, just regular government, down 42 month over month. That's January. And then there's just a big adjustment. There's really nothing that's jumping out. Leisure and hospitality up, which is probably bullish because we've seen a lot of not that. Professional business services slightly down, retail slightly down, social assistance payrolls big up for some reason. It's kind of a weird, funky mix. But if you kind of use the rule of thumb that prior to us removing the birth death model, the number is somewhere plus or minus 85,000 from where we're from. It was either a very small miss, or we could be undercounting by an additional 85,000 jobs, making it somewhere closer to 220. So I wouldn't throw a ton of weight behind this, but it's pretty interesting. But I think that the big one is private payrolls up huge, government payrolls down huge, and the number is still up quite a bit. And so I think if that data is accurate, then that's great. That's what we need. That's kind of what we talked about yesterday, where if we take people from losing us money actively, aka government jobs that provide no return, and move them into the private sector, that at least the goal is to make a return. That's very positive for GDP in my mind, even if the unemployment rate rises in that process.
In the professional services space, a lot of people in our neck of the woods, from a career perspective, getting a little panicky about the AI Grim Reaper coming to town and disrupting the wealth management business. A number of stocks really took it on the chin yesterday. LPL was down 7%, Schwab down 7%. Looks like Altruist AI is kind of the main disruptor. I've read about Altruist. I have not done a deep dive on it. I don't know if you've looked into them at all.
Yeah, I did a search of my email yesterday to see when the first time they had emailed me was, and it was probably 3 or 4 years ago. We looked at their pitch deck. It looks pretty sweet. Yeah. I don't know that the average person could do a better job managing their portfolio using it, because there's a lot of the functional pieces of doing what we do, which is hard, which is, the tax management, harvesting losses. I think what ultimately, I mean, I don't know, robo-advisors, what they used to call them, and that was 15 years ago when they rolled out ETF models that automatically adjusted for you. You know, there's companies like Acorns or Betterment that do this and have done this. I think, honestly, if we could put altruist AI into the lap of the boys here, I think we would, if anything, be far more efficient at managing money, especially the way we do it, which is individual stocks, individual bonds. I mean, the platform looks robust, and it'd be very helpful for quickly rebalancing portfolios. And we've already put a ton of time and effort into. I mean, we used to make individual trades on individual accounts all the time, and now, you know, we get the model set quickly using, you know, I don't know if we call it AI, but certainly programming.
Yep.
You know, a lot of work has been done by Sam, who doesn't appear on the podcast, but does a lot of work in that regard. You know, the trading part, we have things like iRebal, which was rolled out by Schwab, where you could trade an entire account just by plugging the model you want in, and it'll adjust for, you know, taxes and things like that, putting things in the right account.
We've seen massive spikes internally in trading volume, even on a per client basis year over year. Last year saw a big uptick. The year before, a little bit of an uptick. This year, strong start.
Yeah, if I wanted to,
which I think is a good thing. The reality is, I view our space is not unique from the standpoint of how I view AI, but I think there are going to be companies that don't replace personnel, but they make personnel significantly more productive. You know, as you think about growing a business internally, we want to double every 5 years, and we've kind of maintained that pace. Imagine being able to do that, not increasing headcount, because, hey, we've gotten more efficient internally. And that was a priority 5 years ago. We hit the growth benchmarks we wanted to hit, but headcount's basically flat because we did increase productivity. Yeah. So any tool we can leverage to do that, I think, frankly, gives us more ability to spend time with people, which ultimately we probably care about investment performance more than a lot of our clients do. It's not that they don't care, and I'm not saying they should care more, but I think what they really value is the relational side and knowing that, you know, hey, somebody's got my back and is thinking on my behalf, and I know that because I'm spending time with them. They're reaching out. We're having conversations.
Yeah, I mean, I think a lot of this business, and even this podcast is that, which is a little bit more of the, you need to show that you know what you're doing and that you're looking after the clients and that you know what you're talking about. And, you know, the origins of this podcast were, we can't be on the phone all day. We need to make trades. We didn't have as much automated trading, or at least quick trading, as we used to. How can we get as much information out in the shortest amount of time that everyone can see, and then go do that trading and make sure we're making the right decisions? And I think, I mean, honestly, I want to get my hands on this sucker.
Yeah, we need to check it out.
Because it used to be, I mean, we managed a third of what we manage now in terms of total dollars. Half as many accounts, maybe less. Yeah, probably less. And it would take a lot more time to trade the accounts. And it was a lot of, you know, doing the math in Excel, trying to figure out exactly what you need to do.
Yeah, kind of the middle stage that really is probably the least observed by the client was 80% of the job. Yeah. And now we've been able to shrink that so we can spend more time on the actual research and diligence of ideas and valuation, and more time on the client side.
Yep.
Which I think is a net win for us as well. I mean, I certainly enjoy that a lot more than spending a day inside of Excel to trade an account.
Yeah. I mean, it used to take a week and a half to rebalance all your clients. Now it could take, I mean, if you go hard for a day and a half, you can get everybody done.
Elizabeth Warren and Josh Hawley, an unlikely duo, pairing up to introduce legislation to break up big medicine. They're going to try to get rid of parent companies that own medical providers, so pharmacy benefit managers, insurers, trying to break up the likes of the United Health and CVS's of the world, specifically with an emphasis on the pharmaceutical management side, which this has to happen. It's such, as Ben's talked about, a big theme for this year is the evaporation of just the rent seekers, and no one demonstrates rent-seeking behavior more than the PBMs.
And we talked about it yesterday, like what are the things that could lead to 15% GDP, which, you know, Trump tweeted out and we've never seen before. And this is one of them. I mean, it's the biggest drag on the deficit that there is. There's zero transparency. Nobody knows anything. and I've said it on this podcast before, and I called for this a couple weeks ago when we were talking about, hey, what's something that could be way off that could happen this year, and I said big breakup of United Health and these big medicine companies, because I don't know how else you can get this thing undone, because we didn't get changes to Obamacare, and maybe that's not really the real problem. The real problem is we don't know anything about what goes on in these companies. And I'm not a big government guy. The antitrust stuff for the most part I think has been a net negative. I mean you name it, there's been problems with companies trying to buy other companies and the Department of Justice getting involved. This is not the case here. Yep. This is breaking up Standard Oil. This is breaking up Southern Bell, or the Bell companies, and making what eventually became AT&T. But the difference is when they broke up Standard Oil, it became commoditized. Gas is gas is gas is gas.
Yep.
When they broke up the telecom companies, it became commoditized. A cell phone is a cell phone. If they could do that with medicine,
yep,
break this up, every company now has to compete to make money, and you can't do all this, cloak and dagger garbage. It can get commoditized, and things that are commoditized, they drop in price. Yep. You have no pricing power, and that's what we need in healthcare in order to right this ship. So in addition to everything we talked about yesterday, God, we need this. We need this more than almost anything in this economy, I would argue. And it's not a free market idea to say, hey, we got to break these things up, but I think it would actually free the market.
Yep. I mean, you think of whether you're thinking at the government level or the human level, the amount of money spent on this stuff is just staggering. And then think of all the other places that money could go.
Yeah.
That's where you get growth. The fact that healthcare inflation historically is so high, and I'm not talking about since 2022, like it's long-term so high, and it's essential, it really puts a dampener on any kind of budget exercise that would otherwise allocate cap money to other places and spur growth. You're paying so much more for the same thing every year.
Yeah. And it's not like the doctors are making more money.
No.
Pharmacists. I mean, none of these people are making any more money. Like, I would argue being a doctor has to be the worst job.
Yeah, it's worse now than it was 20 years ago.
Yeah. I mean, when you were a kid, you'd be like, well, man, his dad's a doctor. You'd be like, man, he's just printing money.
Yeah.
He's got a BMW. Yeah. What a G. Now you're like, his dad's a doctor.
He's got a phone in his car.
Yeah. And now it's like nobody likes doctors. Like, because you go to the doctor and your appointment's at 3:15 and you walk out of there at 6:15. It's dark outside and you're like, I didn't even see the doctor.
Yep. Where is that guy even here?
I met some guy named Chad, and I think he was like a physician's assistant, but I'm not real sure. He gave me antibiotics.
He just said he was going to be checking me out today.
Yeah, exactly.
T-Mobile down about 4%. Solid numbers on most recent quarter, beat on earnings per share. Record of free cash flow, quite strong, $4.9 billion. Adding customers, low churn rate, but stock is down with a soft guidance.
Yeah, they gave slightly lower free cash flow guidance. That's really the only thing I can think of that's causing them to be down. So I wouldn't be surprised if they came back up to flat at some point, because, I mean, the numbers were good. I mean, T-Mobile is the nicest house on perhaps the worst block in all of the market. I mean, telecom is for the most part garbage, and as soon as Starlink goes public, I think it's just going to go away. Because why would you not just want to have a phone that can get access to the internet no matter where you are? Yeah. Because you're just linking up to space. So, I mean, the numbers were good. We do own this for more conservative, older clients. I mean, it's a low beta name, and I just wish that the performance had been beta over the last 6 months or so. But, historically, it's a little bit of a ballast of the portfolio. That's not been the case so far this year. But, I fail to think that telecom is somewhere we'd have a lot of money in the next 10 years.
Yeah. All right. We're going to wrap it up there. Futures look up just a bit. Any movement on the fixed income side or on WIRP or anything?
I mean, we had a huge move yesterday. Rates came down. We settled down at about a 4.14 on the 10-year. I'm trying to log into my Bloomberg here. The internet, you may be surprised in the podcast studio, not strong. And I've been logged out of my Bloomberg. Okay. We'll look at it tomorrow, but yeah, nothing I've seen so far. But let's see if I can get it on the internet here. Bad podcast. Let's see if I can see the whole.
This is good radio.
It's nice to see the whole curve at one time, but it will just do the old CNBC 10-year Treasury. We're at a 4.19, so rates are up. So the expectations for additional cuts dropped would be my thought.
Yep.
There is that
Yeah.
people were thinking we're going to get a big down number. We actually got a positive number. Is it real? I don't know. I wouldn't put too much stock in it,
Yeah.
but we're going to keep an eye on the trend.
Let's do it. All right. We'll wrap it up there. Y'all have a great day. Talk to you tomorrow.